Over 1,000 points. That's the massive drop the Nikkei experienced in Thursday afternoon trading as markets reacted violently to breaking news out of the Middle East. Hello everyone, welcome back to AI Market News. Today, we're tracing the direct domino effect from this sudden geopolitical shock straight into our portfolios. We'll unpack how a distant conflict reshapes the entire calculus for US equities, the Japanese market, and our currency. Let's dive right in.
So based on available data, Iran's retaliation against American bases pushed WTI crude right up to the $92 handle. As you can see in the chart, there's a sharp upward reversal, which represents an immediate shift in risk. Now, why does this happen? It's pretty straightforward. Geopolitical conflict in an oil-rich region directly threatens the global oil supply. And when supply is threatened, markets panic and instantly drive up energy prices for all of us.
This sequence right here brilliantly illustrates the macro forces we're currently facing. It's a crucial cause and effect chain. First, we have higher oil prices. Second, this leads directly to sticky inflation. Basically, a spike in commodity prices acts just like a tax on the global economy, keeping overall costs high. Third, because of that, we get delayed Fed cuts. With inflation staying elevated, central banks simply can't safely lower interest rates. And finally, step 4 brings tech valuation pressure. Higher borrowing costs compress the valuations of growth stocks, stalling out the incredible momentum we've seen in the tech sector. According to current market information, this energy channel is visibly damaging the disinflation narrative. April CPI came in at up 3.8% year over year. That's the highest reading since May of 2023. Plus, April PPI surged 6.0%, which is the largest jump since 2022. The underlying mechanism here is that sustained, sticky inflation forces the bond market to reprice the long-term cost of money. This shift is so significant that some models are literally floating rate hike scenarios for 2027. That's a dramatic pivot in expectations that could completely reshape our near-term landscape.
Let's look at the stark divergence on this slide. On the right, U.S. 10-year Treasury yields are climbing rapidly, nearing 4.5%. Compare this to the S&P 500 on the left, which is actively pulling back. Why the divergence? Well, there's a direct inverse relationship between bond yields and equities. When risk-free government bonds offer higher returns, capital naturally moves away from riskier stocks. That pulls down equity valuations and effectively ends our recent ceasefire optimism.
Now focusing back on Japan, the graph shows how quickly this global geopolitical shock wiped out the historic high of 65,158 that the Nikkei hit just recently on May 25th. The reason for this intense reaction is that Japanese markets are highly sensitive to global economic growth and rely incredibly heavily on stable energy imports. When global risk appetite drops and oil spikes, Japanese equities face immediate, intense selling pressure.
This dynamic is also clearly visible with USDJPY remaining elevated near 159.50. So, why does the yen stay so weak against the dollar in this kind of environment? The mechanism is driven entirely by interest rate differentials. Higher US interest rates make holding US dollars much more attractive for yield-seeking investors, and that maintains intense upward pressure on this currency pair.
So the absolutely crucial point is how our central bank interprets all this data. BOJ Nihon Ginko Governor Ueda recently stated that the current situation is nothing like the 1970s wage price spiral. Here's the dilemma. If an oil shock primarily pressures Japanese household real income by raising the cost of living without a corresponding boost in wage growth, the central bank is in a tough spot. They might prefer to wait for more data to ensure economic stability rather than rushing into a June rate hike.
Given these conditions, we really need to adapt our strategy. This slide contrasts the current defensive playbook against rate-sensitive risks. Right now, according to current market information, there's a strong rationale for going long on the energy and defense sectors. On the flip side, we have to be incredibly cautious about rate-sensitive areas. Persistent inflation compresses the valuation multiples, even for our absolute favorite AI tech stocks, making long-duration growth assets much more vulnerable in the near term.
To gauge the broader market sentiment, as you can see in the chart, the VIX volatility index is creeping back up. Renewed geopolitical conflict puts a firm volatility floor in place. Why does this happen? Because ongoing military uncertainty means the threat of sudden market disruptions remains a constant. We should expect continued turbulence, with the VIX floating around the low to mid-20s until a credible ceasefire emerges. Before closing, let's reference the economic calendar for our upcoming key indicators. Please note that all dates and times here are in Japan Standard Time, or JST. Next week, we have ISM manufacturing and services data coming in, but that Friday U.S. jobs report is the major macro pivot point we must all watch closely. Definitely take a moment to mentally bookmark that date. A hot labor market reading would further cement inflation fears, while a softer print might just give equity markets some much-needed relief.
Will the May jobs print kill rate cut hopes or reopen the debate? That's the core question for our near-term equity calculus.
Thanks for watching. Please subscribe and hit the like button.
This explainer was automatically generated by NotebookLM AI. AI-generated content may include errors. This explainer does not constitute investment advice. For full details, please check the description below.